Let's welcome on board Gautam Trivedi, joining in to chat about what he's making of the market right now. Gautam, hi, morning. I guess it's not why the markets are falling now, it's about how much more will they fall. And now with this, sporadic chatter between Trump as well as China, that also keeps us at bay.
No, absolutely. I think the market is falling for two reasons. One, of course, the underlying economy is seriously struggling and it's actually not improving. We've had 5 years of sub 5% earnings CAGR for the Nifty 50. In spite of that, the market actually rallied over the last 5 years. I think the market pretty much peaked in September of last year. But given now where we are in terms of the economy, in terms of the underlying sentiment, and I don't mean just the MSME sector, it's even the large cap companies that are obviously complaining. We are heading further south as far as the market's concerned. And the other reason, which I must also mention, is the fact that this unnecessary surcharge on FPIs. So the government went after about whatever it is, 10 or 12,000 people who have a taxable income of 5 crores and more and imposed a surcharge. But the fact is, it unleashed a much, much bigger problem, which was totally unnecessary at this point of our economy and the growth of the capital markets. So I think the government needs to wake up and immediately remove that surcharge for FPIs and AIFs domestically.
Right. If that were to happen, Gautam, it's not going to be as vanilla as the government just rolling back that surcharge. Recently the finance minister was talking to the Economic Times and saying that, she's willing to give a hearing here, but that's that. It didn't seem like a rollback is going to happen. But, on the market per se, we've fallen, almost 1,000 points from the top just for the Nifty benchmark alone. How much more selling is likely to happen purely because of, all the parameters that you talked about?
Well, let me put it this way. Let's look at the FII selling, which has been unabated since the day of the budget, which was the 5th of July. We've seen over $2 billion of selling. I think that could accelerate if the government doesn't make up its mind on what to do with the surcharge. And let's look at some other empirical evidence and data. We've got a situation where 25% of the global debt that's out there is yielding negative returns. The Fed has just cut rates, and other countries, I believe, will follow suit. At a time like this, what naturally happens is more money gets into the equity markets globally. So we will see more money coming into emerging markets, into Asia. And as a result, we would have benefited of that money coming into India. But we're among the few countries where money actually is leaving. So I think this is a much bigger problem. And I'm repeating myself here, but the government just does need to wake up and solve this ASAP. The market could turn on a dime if that surcharge is indeed removed.
Right, but what this also is doing is making prices look attractive. So which sectors do you believe there will be buying? It's not that you can ignore India or you can completely start to have a zero weightage as far as Indian markets are concerned. Where do you expect buying to come in?
I see buying coming still in defensive sectors because, like IT, maybe some in pharma. I would still stick to the private sector banks. Again, that's a trade that's been going on for the last 10 years. And the PSUs, obviously, the interest and appetite for PSUs is very, very limited. So these are the sectors I would focus on.
But, when you talk about defensives, would consumption still be a part of that? We've yet not seen a slowdown in consumption for really a long time. How will high valuations, commentary not being that great, numbers not being that great, be taken by investors?
I think there might be maybe some correction in the consumption stocks, but the fact is India is essentially a consumption-driven market. So at the end of it, I think the money will flow back into consumption-driven stocks. And I think a lot of names like the levers, Imami, which is obviously at a major fall because of reasons not related necessarily to their core business, but more because of promoter pledge. So a lot of these stocks are starting to look interesting, and I think that's where the focus should be at this point.
Private banks, you said, is one interesting space, but one after the other, you're getting a problem. So earlier it was infrastructure space which was defaulting. Then you had this entire NBFC issues, how things will happen, and now it's the promoter leverage in various group companies, which is acting as a big concern. How will you look at private banks? How do you differentiate between these banks?
Good question. I think let's look at two specific private banks which have gone through senior management turmoil and also issues with respect to their NPLs. Both ICICI and Axis have done extremely well in the past 12 months. So change in management, change in focus, and rejigging the entire senior management structure has significantly benefited both these banks. So I like these two. Of course, the HDFC twins will continue to elicit interest from investors because they've consistently delivered strong returns over the past 25 years. So these are the names I would stick to. Indus still looks interesting, as does Kotak. So again, very usual names. I'm not necessarily bringing out a rabbit out of my hat and saying that a new a new bank should be looked at. But these are the names that we would think of investing. We're of course a mid-cap fund, but I'm saying from a large-cap perspective, these are the names we would stick to.
That's interesting. Within the mid-cap universe then, Gautam, where are you spotting opportunities to buy in the current decline? Because for the broader universe, the decline has lasted for a while now.
But, Aisha, what I would say is I'm not at this point even propagating. I'm replying to your questions, but I'm not necessarily propagating putting money to work in this market as yet, until, of course, the government changes its stance. Even if you look at the empirical data that's coming in over the past 3 months for domestic flows into domestic equity mutual funds, so you've seen about 8,000 crores of an average of SIP money that's come in every month for the last 3 months. Having said that, net of SIPs, the number actually is lower, i.e. the money outside of the SIP money actually has been a negative. So that's a cause of worry, and that's something I think we should really think about as to why that's happening. But outside of that, I am not in favor of adding significantly at this point of time. I think the market's got more downside until we get clarity on the FII issue.
Gautam, one more sector which you also keenly observe, and this morning there's reason to talk about that given the large quantum of loss that Bharti has incurred. We've already had Idea fallen sub those 10 rupee per share levels. Yeah. We already know the kind of large debt that these companies are riding with on their balance sheet. And now you've got talks about 5G coming in. I wonder, how is it that they're going to even take that load of 5G? Where are they going to cough up that money for the 5G infrastructure? What happens to telcos?
Yeah, I think, I was chatting with a friend the other day and I said 3 years ago, a perfect pair trade would have been long RIL, short Idea. I mean, Idea has pretty much even outpaced now MTNL in its fall, going down as much as 95%. So it's been a sad state of affairs for the telecom space from the listed company standpoint. But my view is that, again, in the case of Idea or for that matter Bharti, both these stocks could turn on a dime the day Reliance starts to raise its tariff. Now, of course, that may not happen for another 12 months, who knows. But given how much Idea has fallen, would I still look at it from for a company that's gone from a large cap to now a mid cap with a 19,000 crore odd market cap, would I still buy it? The answer is no. And very much for the reason that you stated, which is the fact that do they have the capex and the might to even start a 5G capex program? And if they don't, they're going to be lost and they'll be left behind in the race. They will see significantly more customers leaving and going to competition. So I think at this point, I would stay away from the telecom market.
But Gautam, just wondering, because just everyone is saying the finance minister herself seems to be pushing for a rate cut from the RBI. Do you think that really is the answer? That's the need of the hour? Maybe a quantum as steep as 50 basis points? That is what some of the market men have been talking about, that's what the RBI needs to do, a quantum of 50 bips, and that's going to maybe push ahead the kind of demand slump that we are in. Do you think, A, the RBI would do that? B, is that really the answer?
I think that's part of the answer. Will they do that? I obviously can't answer that. But should they do that? The answer is yes. That is one of the needs of the hour. But the other need is transmission. And the problem is there's money sitting with PSU banks, sitting with private sector banks, but the transmission isn't happening because there's fear of the economic slowdown. And somebody needs to step up and take the initiative to start lending, which is clearly not happening. Second issue is with respect to the NBFC crisis, which is, I don't think, completely over yet. And if another shoe were to fall in the NBFC space, I think that will further contract the availability of liquidity in the market and further curb consumption. So I think banks need to take the initiative once the RBI cuts rates to actually be bold enough and start lending. And that, I think, hasn't happened as yet.
NBFC crisis is not yet over, the NBFC issue is not yet over. What needs to be done over there? Do you see a big NBFC having issue or smaller NBFC are really struggling?
I see it at both ends, actually. So let me give you an example. One of our top holdings is Aavas Financiers, and again, we own the stock, so full disclosure there. But one of the reasons we actually like Aavas, besides the fact that the quality of management is first rate, is the fact that they don't have any leverage at this point. So they've been using their IPO money up until now, so there's no ALM mismatch, no issues there whatsoever. So I would recommend today people to look at some of those names which are under-leveraged, don't have asset liability mismatches, and focus on them versus trying to find value in some of the beaten down NBFCs, because we just don't know the quantum of the issues or the NPLs that may have not been fully disclosed.
Okay. When you're looking at consumption, Gautam, and you're talking about being bullish there, anything from the mid-cap arena that's catching your eye, any particular rationale or theme that you're going with in the mid-cap basket?
Well, we like, again, one of the stocks we own, and we would add more if it falls further, is Varun Beverages. It's the bottler for Pepsi, now has 80% plus of the geography of India, plus the fact that Pepsi has given it other markets, including Morocco, Zimbabwe, and Zambia. So that shows great faith that Pepsi has within Varun Beverages. And Varun doesn't just do the carbonated drinks, it also does Tropicana, and will soon be launching its own brand of dairy products. So I think that's a stock we like, and we will certainly add if it were to fall more.
Okay, that's Varun Beverages then, that's looking good to you. Anything else, Gautam, in the sense of from a valuation perspective as well, that's perhaps looking attractive to you at these levels from the broader market?
A lot of stuff does look attractive, but we're just scared to actually add at this point of time. So we've seen the building material space, we've seen the appliances space, electrical appliances, kitchen appliances. Besides the fall, the other concern I have within both these sectors, the building materials and the electrical/kitchen appliances space, is that people existing companies are getting into each other's stuff, and we've seen a lot of evidence of that over the past 12 months, where a company that's traditionally been in, for example, making sanitary ware is now getting into ceramic tiles, and vice versa. So not only is the fact that the economy itself the underlying economy itself is hurting and sales aren't picking up, the other problem is the intensifying competition in both these sectors. So I would right now stay back and see how this plays out before actually adding more. We don't own anything within that space right now, but if somebody already does, I think they should wait and watch.
Right. What do you make of this intensifying competition? One side, liquidity is low, or it's not so easily available, and second side, you're getting competition, and competition always comes at a cost. So do you think on twin issues, a lot of sectors, companies could have problems for near term?
I see that happening. And let's not forget, both of these, building materials in particular, is directly linked to the real estate space, and we're not seeing any significant improvement in the real estate space. So until that doesn't turn, which I think is at least about 1.5 to 2 years away, I don't see why building materials would be an attractive option at this point of time to invest in.
what is it that you're making of this entire slowdown within the auto space? Seems like it's far from over. Just yesterday, you had all the sales data pour in. But do you think in terms of the stock price valuations, are they anywhere close to bottoming out?
I would stay away from the auto sector right now because you've got multiple headwinds besides just BS6, which starts from 1st of April next year. The threat of the EV, which is 5 years away, and again, conflicting signals from the government whether it is going to be fully enforced or it's going to be partially enforced. Until that doesn't clear, I would stay away. The other issue, of course, is that a bunch of auto ancillary companies which do a lot of exports, even they are hurting. So we met recently two specific auto anchor companies who have bulk of their revenues from exports, and they're not doing well either. So I don't think the auto slowdown is a Indian-only issue. It's a global issue. But of course, a lot of the problems here also are specific to India, i.e. the NBFC crisis or BS6, or for that matter, potentially EV, depending on what finally the government decides.
Right, Gautam, just as we move ahead, Nifty has eased all the gains for 2019 after the fall of today. Nifty has turned negative for 2019. Now, Gautam, you were pointing out towards the FII issue and how they have been continuously selling. When you look at the data, now Nifty has not done anything in 2019 so far. Doesn't that make things look attractive? You always interact with FIs. You've always been doing that. When they sell, they don't really look at levels. They just either it's a call either to exit completely or to be overweight on any country, any name.
Let's be fair. FIIs have been very supportive of the Indian equity markets for the past 25 years. They've invested in IPOs, QIPs, government privatizations, and frankly, we should be welcoming the FPIs at this point versus telling them that, yes, our economy is in deep trouble, but we think putting a tax, a surcharge on you is justified at this point. So, they have over $500 billion invested in India. And a $2 billion sell down in a single month is just the tip of the iceberg if they actually get upset and start selling. So at this point of time, I think we should woo them back. And I hope the ministry and the PMO are listening to this and, take significant steps to bring them back into India.
Thanks for joining us this morning, and we're with you on that for sure.